important public interest is and how far it has come, that even the United States are beginning to consider various public interest factors. And so I believe that as soon as he gets an opportunity to, if he's not already, he will log in and certainly watch this specific plenary session and listen in quite keenly. Bake, I see we are now live on YouTube. And so Bake, I will hand over to you. If you can then introduce your panelists, and then you can take it away. Thank you so much.
Thank you very much, Simpiwe, and afternoon to everyone. In a sense, Simpiwe is correct. The other sessions have really paved the way for this session, because there has been a ringing endorsement by Bill Kovacic with reference to Lina Khan, that the original intent, as well as the broad goals of antitrust laws, are designed not just to protect consumers, but also to protect workers, entrepreneurs, independent businesses, and the like. And Elena Fox re-echoed this point and warned against the dangers of convergence and asked a poignant question as to convergence to what? And she said that convergence is convergence to the US as well as Europe. And there is absolutely no doubt that in the case of public interest, there is a direct link or a direct connection with the Constitution. And part of the question that is really sitting at the heart of the debate in relation to public interest issues is whether public interest regulation in measures enables or disables investment. And to assist us in unpacking that debate, we have Lindiwe Madonsela. If you can please, panelists, switch your cameras on. We have Lindiwe Madonsela, who is the Senior Manager for Advocacy and Awareness in the Compliance Division of the BBBE Commission. We are also joined by Pamela Mondliwa, who is the Senior Managing Consultant at Berkeley Research Group. We also have my colleague, Tamara Paramu, who is an economist and head of mergers and acquisitions at the Competition Commission. And we also are joined by Lindokuhle Mkhumane, who is the acting DG at the Department of Small Business Development. In terms of the format of the session, we will allow our panelists to make opening remarks in 5 to 10 minutes as they wish. That will then be followed by a debate, as we had agreed with the panelists. I will pose some question for debate to the panelists, and then that will then be followed by questions from the floor. We hope that we should all be able to cover that within the time allocated. Perhaps to start us off, let me then invite Pamela Mondliwa to then start with her opening remarks. Pamela, over to you.
Good afternoon, Bake, and to my fellow panelists, as well as the audience at large. I am happy that I was able to join the panel so I can share my views on some of these factors. Today, I really want to maybe touch on 3 points. And the first one is that I want to frame recovery and transformation and perhaps reflect briefly on the role of merger enforcement with reference, of course, to public interest in supporting recovery, economic recovery, sorry. And the second point I want to make is a few comments on the enforcement challenges of public interest provisions and the role that economists can play in balancing the various provisions that we have in the amended Act. And then the last point is just some brief reflections on the commentary that we've seen, particularly around the Burger King merger. And here I want to pose some questions, perhaps for broader BEE policy in South Africa and how we think about it. So to start off with the framing, I think Bake has described the session really about looking at how public interest can support recovery. But in my thinking about it and in the way that I will talk about it, I'm going to use a broader concept, which is that of economic resilience. And this is, of course, because South Africa wasn't doing well, before COVID. So we don't just need to recover to where we were before, but we need to think about how we can create or support and foster an economy that is more sustainable, that can sustain longer term growth, one that is more inclusive, and one that will, of course, be more resilient to future shocks. And when in the context of economic development and sustainability, economic resilience is really about three things. It's the ability to recover quickly from a shock, the ability to withstand a shock, and the ability to avoid the shock altogether. And what this means is that you want an economy that's more diversified, which is one that is not reliant on a few industries. So if there's a shock that is perhaps limited to an industry, then the rest of the economy can function. I imagine it would be quite terrible for South Africa if mining alone had to stop, even if other industries were to continue. And this is, a big issue given that we've been trying to diversify since 1994. Then resilient economies are also economies that are more dynamic. And this is including through supporting competition on merits. This is making sure and allowing that all entrepreneurs have the ability to contest markets, of course, based on merits. And there's a role here for competition policy, which is around addressing barriers to entry, but it also requires thinking about how to support meaningful participation by Black entrepreneurs. And then another important aspect of a resilient economy is one that has stronger linkages within the domestic economy. I think we saw with the global supply shocks is that when you can't get access to certain inputs, then production can stop. So how are we making sure that market dynamics are supporting the growth and development of some linkages and vertical linkages within the economy? Now, so that's just the broader framing and where I'm coming from in terms of all the points that I will make. But if we focus on the role of competition law and particularly focusing on merger control, I think we have to accept that there's a limit to how much merger control can do with regards to this. Because if you think about it, the barriers to entry that competition law usually seeks to address are strategic barriers, and much of that, of the tools to do that lie within the abuse of dominance provisions. There are, of course, the public interest provisions do provide tools to address some of these things, but I do think that the bulk of them lie outside of merger control. And then to some degree, what the public interest provision do is that they give us tools to address some of the structural barriers that you would see in markets. And an example of this would be allowing mergers that allow the parties to reach economies of scale, even if they were to raise some competition questions. This is at the heart about making sure and supporting firms that can compete in international markets, which can also allow us to have more sustained growth. Then there's, of course, the third and probably the aspect that everyone that is listening to the session is interested about, which is about the ownership provision, which seeks directly to refer to inclusion. I think a brief reflection overall that we needed in the amendments of the Competition Act in 2018 to include a provision that sought to only exclusively to address ownership after we've had BEE policy and other policies that seek to support meaningful participation in the economy, I think is a reflection of South Africa's failure with the inclusion agenda. But moving more to then, what are the kind of enforcement challenges that can arise from public interest? And I think the key challenge here is really that how do you balance the various public interest provisions that exist? I mean, there are public provisions that are seek to address static issues and some that seek to address dynamic issues. So then how do you create a formula or some sort of, how do you do the calculus to say, if all of these public interest provisions arise in a merger, what weight do you apply to which of the provisions? And there's been a debate in competition economics, of course, around what is the appropriate objective of competition law. Is it to foster static effects, such as maybe simply targeting pricing outcomes, or is it also about fostering dynamic effects, which are thinking about how do you ensure that your markets are innovative, are able to invest and achieve the long-term kind of growth that you need for economic resilience? And here, what we have is an instance where it's not seeking to look at either or, which is how the debates are currently framed. And I think this is what you're referring to, Bakio, when you're talking about what Elena Fox has been saying. This is one of the debates that she's been contributing to over the years. Here, what we have is not a situation where you're thinking, which one is better? Should I go for the one or the other? But you're thinking directly about how do you balance these two things? And that's not an easy answer. And I think perhaps it is suggesting that we may see economists playing bigger roles in merger analysis when we have these issues arise. But something that I think is important to say is that the guidance on this balancing of these provisions is most likely to come from the precedent. And then in this instance, we need to ask ourselves whether having two separate avenues for dealing with the balancing act is helpful. And these two avenues, of course, being merging parties can go directly to the commission or they can go to the ministry. I do think that it creates a scope for forum shopping on the one hand, noting, of course, that the commission has the scope to disagree with arrangements between the ministry and merging parties. But more importantly, I think what it does do is it slows down the process of developing the precedent that will allow for clear guidance on how it is that merging parties should be filing their documents and how it is that the commission, tribunal, CAC, all the various competition authorities would then engage in that balancing act. And then the last point that I want to talk about is the point about what the enforcement of the public interest, the amended public interest provisions are telling us about BEE policy more generally. And to kind of illustrate my point, I'm going to use the criticism that has been posed against the Commission's approach in Burger King around how the Commission's approach is giving rise to a liquidity discount on transactions where the sellers are BEE empowered. I mean, the argument follows that the approach that the Commission has taken to enforcement will end up hurting the very people that are seeking to support. I mean, two things come to mind to me whenever I hear this argument. And the one is that merger enforcement is not the only instance where we see the implementation of BEE policy resulting in liquidity discounts. Another example of this is shares from BEE deals that are traded on the BEE segment of the JSE. And I think that the BEE segment was created as a solution to the challenges of the lock-in mechanisms in previous deals. But what it does is that it creates a secondary class of share trading, which is only for Black people. And by that very nature, that creates, that leads to a liquidity discount on those shares. So what is it that we want to say as the country? Are we saying that we do not want liquidity discount? And if that is the case, then we should be saying that we should be re-looking at BEE policy overall, rather than focusing only on the merger issues. And then the second thing that comes to mind is that the size of the liquidity discount is a function of the number of available Black buyers, right? So if there are more Black people, that means they will compete to acquire that particular firm, and you'd see the price rising, etc. So the liquidity discount is what it is because there's such a small size of potential Black buyers with the means to be able to purchase firms. So in order for us to overcome the liquidity discount issue, we need a better racial distribution of wealth, such that it's not such an issue. And what then that leads me to think is that we have a chicken and egg problem in terms of which one do we get to first, because we need those two things to be present together. I think I'll leave it there for now, and looking forward to the engagements and discussions later.
Thank you very much, Pamela. Certainly the debate has started. Tamara, over to you.
Thanks, Bakir. There are a lot of things that Pamela has said that has sparked my interest. But I think let me make one point and then I'll go over to my prepared remarks. And this liquidity discount that Pam speaks about, and the fact that she's saying, it's reflective of the low levels of participation, I guess, by Black people. I think it's useful always to remind ourselves, take a step back, remind ourselves of the scale of this problem. Because what we are talking about is more than 90% of the population of South Africa, and yet there is a liquidity discount of this size. So I think it's just alarming, I think, that we're still talking about this in this way in 2021. But that said, my opening remarks. So I think thankfully, I'm speaking at a time when we no longer have to debate whether competition law and policy can and indeed should strive for the goals of equity and efficiency. As Bakir mentioned, and as Prof. Fox reiterated yesterday, any South African competition law that did not acknowledge the exclusionary past would not only have been ineffective, but it would have been unjust and I would say illegitimate. Similarly, I don't think there's any debate about the extent of concentration and the lack of transformation in the economy. It has been referred to by various speakers, and the Commission's concentration report has been mentioned. But I think the important point to remember is that this is a factor that constrains growth and also is unsustainable. And we would do well to remind ourselves, I think, of how this manifests itself in July this year. So it's worthwhile just to contextualize this, and I'll do it very quickly. So the economic context in which we operate in. The OECD released a report in 2021, a short report, that estimates our income Gini coefficient at 0.62. Wealth inequality, as Pam alluded to, is much worse. So studies by the Wealth Inequality Lab says that 10% of the richest South Africans own 85% of the wealth. And that the richest 1% have actually increased their share of wealth since apartheid. Direct investment by Black South Africans on the JSE, which I can use as a proxy for ownership, well below 10%. And then, of course, we know that we've got unemployment officially at 34%, but it hides a much deeper crisis, or where youth unemployment, those between 15 and 24, on the expanded definition, is 74.8%. And in addition to that, as the concentration study points to, we have an economy that still has a low level of dynamism. So new entrants and smaller firms are more likely to exit than they are to grow into small and large firms. So this is unsustainable. And against this backdrop, we ask ourselves, is public interest still relevant, and should it be ramped up or scaled down during this time of economic recovery? So I want to make 3 points in response to this. One is that, and this echoes a point Pam made, is that the government's response to the COVID pandemic is not about recovery, but it's about reconstruction and recovery. And that document acknowledges the fact that returning to pre-COVID levels of growth is insufficient, but that substantial structural change is required. And then in thinking about what is required, we note that the concentrated markets that we have, they lack diversity and participation, and they're not open to challenges. Now, what do the public interest provisions do? They talk directly to this issue of being closed to challenges, and it urges us, yes, in mergers, but also more generally in competition policy, to think about the inclusion of outsiders. And I think this question around the distributive effect of competition policy in mergers is even more important at this time, when we are all on the same page around the fact that we don't want to recover to where we were, but that we have to build an economy that is open to sustainable, that creates sustainable growth. The second point I wanted to address, and this really is something that arose for me during the past 3 days, is why mergers? And also whether mergers are enough given the scale of this problem that I've pointed to. So it's been really striking over the last few days to hear everyone speak, particularly the minister yesterday, around the transformative impact of commitments in merger control. I think he mentioned a value of more than 20 billion, and I've had a look, and in the past 4 years, I also get to a value of more than 20 billion in accounting for the merger commitments in terms of supplier development funds, ESOPs, BE deals, and the likes. And that, of course, doesn't account for the net effect of mergers on saving jobs, on reskilling commitments, and other commitments to increase local spending above pre-merger levels. So why have we managed to do this in mergers? And maybe this is a little bit of an academic question, but I think the answer is quite important. And it takes us back to a reminder that competition policy is really about understanding power in markets. And the answer to this question of why we've been effective in mergers reminds us about the distribution of power in economies and the fact that those who hold power can shape markets. So what does a merger do? It gives us an opportunity to tilt those scales a bit, to realign the power between firms and regulators. And then it brings those large firms, or even if they're not large, they're otherwise influential, and to bring those parties to the table and to have an open conversation about the role of those firms in inclusion, in transformation. Of course, this is also, I would argue, in their interest if we're thinking about a growing sustainable economy. But you don't need to have that conversation if you hold power, and if that power comes from the status quo. So we do have this opportunity in merger assessments, and the public interest provisions do force us to say, well, we've got this concentration that arises from this transaction. Are there any losers? And then how do we make the firms involved internalize the costs associated with those losses? I think that the way in which we've done this in employment is probably one of the starkest examples. So you have a merger that may result in retrenchments. The merger parties then bear the cost of either implementing a reskilling fund or in future re-employing those employees. So there are those opportunities. And I do think that we do need to take them given the scale of the problem that we face. Then the second part is, are mergers enough? Of course not. And I don't think anyone here would say that they are. And the note that accompanied the amendments in 2018 acknowledged this as well. I think it's clear that structural problems, like a good merger analyst, I would say structural problems require structural solutions. But we do need to think about, this issue of the distribution of power and where we can find power. And maybe that answer lies in the broader range of tools we have available. Simon referred yesterday to transformative industrial policy. There's also the lever of state procurement. And as Pam has so eloquently pointed out, there's the issue around more aggressive, potentially BEE policies and the likes. But anyway, at this point, I think incrementalism is preferred to the status quo. Better is good. Then I'm going to make a final point around this issue of public interest. I started off saying that we're pretty settled, in this debate around equity and efficiency, and we know that they don't conflict. But that doesn't mean that there isn't contestation around the application and the interpretation of the public interest provisions. And this, I think, comes through in the question around how we balance them. But I want to make a more contextual point around this. I acknowledge that there's a need for clarity and predictability and transparency in the interpretation of public interest provisions. We had the 2016 public interest guidelines, and the Commission is working towards amending guidelines in line with the amendments to the Act. Of course, with the benefit of kind of testing those provisions over the past few months. But I have picked up a challenge, and I wanted to close with a kind of call to arms, I guess, to practitioners, but also to firms and people more broadly involved in the economy. I think that the quality of our engagement around public interest can be improved if we try to remember the context that I sketched, and if we live up to the imperative set out in the preamble and the purposes of the Act, rather than living down to a guideline or a rule. So in engagements, and this is a practical point that I've picked up, we routinely have engagements around employment, and there are exclusions to the application of the employment provisions, right? So it must be merger specific, so we exclude certain operational things. But what you find is if I read merger reports and I blink too many times, I'll find an addition to those lists of things that are excluded from merger specific employments, and these things, it almost makes you wonder about the kind of the quality and the cynicism involved in the engagement. If you ask questions about how a merger promotes participation by historically disadvantaged people, you can get responses ranging from most of our customers are historically disadvantaged people, as are our workers. We are employing a Black CEO, etc. And I think that level of engagement doesn't take us far enough, given the scale of the problem that we're facing 27 years later. So I just wanted to implore, I think, all of us involved in this conference to keep in mind that these public interest provisions are about inclusion of outsiders. It's about creating a competitive, inclusive, and sustainable economy. And that the engagement, I think, should elevate those principles rather than seeing this engagement, around one that would satisfy us at the lowest common denominator. So thanks, Bobby.
Yeah, thank you, Tamara. We have already generated a first question, but we will deal with that later. Lindiwe, it's your turn.
No, thank you very much, Bake, and good day to everyone and to my fellow panel members. I think it's quite interesting to hear the points that are coming out from Pamela as well as Tamara. And how I want to then get into it with my opening remarks is the importance of looking at what we seek to achieve with our public interest provisions. So basically what is coming out when you look at measures and when looking at public interest provisions, from a BBBE perspective, one begins to see the broader intention to facilitate a transformation and to also create a balance or an inclusion in terms of the different players that partake within the economy. Now, how then do we link that to the BBBE legislation? The linkage with the BBBE legislation comes into being when we focus on what the BBBE legislation mandates the regulators to do. So basically, the legislation requires that every organ of state or public entity, which includes the regulators, must facilitate transformation. And it has provided specific indicators to the extent to which they will facilitate transformation. It talks to when you are determining a criteria for any authorization that you would provide under any provision of the law. Now, that will cover the measures in this particular instance. Then it goes further to even look at other aspects that are centered around the sale of public assets, state-owned assets. It looks at the issues around the awarding of incentives and grants. It also considers aspects around public-private partnerships. And then also it looks at issues around the issuing of licenses and the entering into concessions or your public-private, your public procurement requirements. So when you look at all of that, the reason why we believe that is important is that it's all centered around the need to include Black people in the participation in the broader economy, because you are seeking to restructure the economy in a sense that you are seeking to strike a balance to make sure that I'm de-racializing the state of the economy. Now, all the avenues that are available to any regulator to be able to do that, then they will be able to do that. Now, it's critical that why then do measures have to consider aspects around transformation in BBBE? It's because the whole BBBE legislation has particular pillars that have been identified to drive transformation. It looks at aspects around ownership, which says we want to see Black people owning part of the South African economy. Now, what does a measure do? A measure allows you to be able to bring about that aspect of ownership in the interest of the public as you are striking to seek a balance of inclusion. Now, also, what does the BBBE legislation seek to do? It seeks to say we want to see Black people in management being actively involved and taking part in the decision-making processes. Now, you're then seeing that even when we have an ownership aspect coming through an employee share ownership scheme, then it begins to say that now I start to look at them at the angle of a shareholder and at the angle of them participation in this critical decision making, as opposed to only looking at them as an employee within this particular structure or institution. Then it also says on aspects around enterprise and supply development. I think it's Tamara who made a reference to some of the remarks that the minister made yesterday around some of the initiatives towards driving inclusion and at the helm of public interest. So we're through those enterprise and supply development initiatives, you are trying to support Black-owned entities so that you are able to capacitate them and bring them within the mainstream economy, looking at what is that are the structural challenges, and then you start to unlock those challenges that are associated with high entry barriers that we see that sometimes create monopolies, that we see sometimes restrict the entry of Black-owned businesses in certain sectors of the economy. So all in all, when you look at why then public interest becomes important, is because we want to change the way in which transformation currently is setting. When you look at the 2020 report that we released as a BBBE Commission, it will tell you, first, when you look at ownership and just isolating it to JSE listed entities, it is sitting at 28% of Black ownership within the JSE itself. And then when you look at that, that is 28% after 18 years of having the BBBE legislation. So then you need to, from your avenues, you need to be unlocking and increasing that particular aspect. Then it means that when you're going to be approached with a measure that will seek to regress even worse that picture, as a regulator, then you are required to make sure that that does not happen for the sake of the public interest. And you need to be then setting within what the legislation empowers you to do to address those particular aspects. And then also when you look at aspect of management control, even also again isolating it to a JSE, we've seen that there's not been much of movement in terms of what it is that seeks to be achieved. So from a BBBE legislation, we believe that measures, they fall within the ambit of the BBBE legislation, and the regulators within that space need to make sure that they do include those aspects that will safeguard the interest, the public interest, as well, make sure that we do transform the economy. I think for now, I will just pause at that. Thank you very much.
Thank you very much, Lindiwe. Lindo, you provisionally have the last word, but it's not the end of the debate.
No, thank you very much, Bake. Good afternoon to all panel members as well as the attendees. I'll try and be very brief, given the time constraints that we are facing. From our side, as you indicated, I'm from the Department of Small Business Development. Obviously, the interest is more on the small businesses. I think as a country, we've acknowledged the role of small businesses in the development of the economy, but also in driving economic transformation. It has been a constant theme and policy position since the adoption of the 1995 White Paper on Small Business Development, as well as the 2009 National Growth Plan and the 2012 National Development Plan. As a country, we always quote the NDP projection of the contribution to jobs, wherein we say by 2030, SMMEs will contribute to 90% of the 11 million jobs that will be created. That we're in a particular economic trajectory at the time, and we believe that at the time that this was going to be achievable. But given the current economic situation that we are facing, we know that these figures might not be possible. But we know that we believe that SMMEs are at the core of the creation of jobs. What we do not reflect, unfortunately, on is the NDP diagnostic of the South African economy that shows that one of the critical structural challenge specific to South Africa is the skewed ownership and control. And I think Lindiwe has reflected on that. The corporate landscape of South Africa has changed remarkably since 1994. However, it remains highly concentrated. This poses a barrier to business entry and expansion in key markets, which are essential for employment creation. The present form of Black economic empowerment are not achieving all the desired objectives. Amongst the public interest factors listed in the Competition Act is the goal of ensuring that SMMEs have an equipped equitable opportunity to participate in the economy. While there is reference to SMMEs, the Act does rely on the definition of SMMEs as contained in the National Small Enterprise Act. And therefore, micro and very small enterprises as well as cooperatives are also included in the scope of coverage. The public interest factor is of great importance to the department, given our mandate, which is to lead and coordinate an integrated approach to the promotion and development of entrepreneurship, small businesses and cooperatives, and ensure an enabling legislative and policy environment to support their growth and sustainability. Due to South Africa's unique political history, apartheid policies excluded the majority of the population from formal employment and economic activities, fueling the growth of large, white-owned businesses. After 1994, the attention to SME development in the country was to compensate for the massive unemployment rate and the inability of the formal employment sector to absorb the unemployed. In addition, the economic context of South Africa has historically been hostile to small businesses. Several industries in South Africa have been categorized as tight oligopolies, where several large firms dominate the competitive landscape, typically producing a large portion of industry output and protected by high entry barriers. Higher concentration levels, whereby a few firms typically dominate most sectors, increase the likelihood of their potentially exerting their market power to the exclusion of other, specifically smaller competitors. In most cases, larger firms may frequently control access to raw material or other strategic resources, if vertically integrated to more than one level of the supply chain. A dominant firm's leverage in the market is often strategically used to push SMMEs out of the market to capture market share, entrench market power, and ultimately drive prices up. Such exclusionary tactics may be surreptitiously invoked, such as refusing to supply the SMME with vital inputs, manipulating pricing of such inputs, or levying abnormally low prices on their own products or those of a vertically integrated subsidiary in order to force smaller competitors out of business. Since SMEs are highly susceptible to cash flow problems and lack of economies of scale, it does not take long before they are driven out of the market. Thanks to the Competition Act, which is here to investigate and penalize this unbecoming behavior, I just want to briefly reflect on the issue of the block exemptions. We know that during the COVID-19 pandemic, especially when we are under hard lockdown, through the Disaster Management Act, the government decided to enforce hard lockdown for 21 days. These developments have been accompanied by expedited publication of numerous regulations aimed at combating the outbreak of COVID-19 and mitigating its anticipated impact on the already strained economy. In particular, emphasis has been placed on enabling both the public and private sector to act swiftly to respond to the healthcare crisis. There are just two block exemptions, I think, as part of this work that was done to mitigate against these. The Minister of Trade, Industry and Competition issued quite a number of regulations, but I'll just reflect on the two block exemptions, which is on the healthcare sector as well as the banking sector. Then on the healthcare sector, we know that internationally government, they intervene heavily in the financing and provision of healthcare. The reasons of this are well established because of the asymmetric information between buyers and sellers, which is patients and doctors or hospitals. Buyers are vulnerable to over-servicing and overcharging. Monopoly power on the part of service providers results in higher prices, lower output, lower product quality. Information is costly to consumers when services are purchased infrequently due to the technical nature of much of medical care and because of the emotional state of patients and the agency required at point of service. It is a well-recognized phenomenon that private markets for healthcare suffer from inherent destabilizing factors which result in systematic cost increases, adverse selection. In the case of health insurance, provider-induced moral hazards, consumer-related moral hazards. Incentives throughout the market are consequently so skewed that the normal rules of competition do not work. prices remain high even when volumes traded are high. Technology remains excessive even when widely used. Hospitals and doctors remain in business even when they charge excessive prices for equal quality or fail to provide high quality services. Incentives exist only for innovations that raise costs or increase quality regardless of cost. A particular undesirable consequence of market failure in private healthcare markets is the spillover effect on public healthcare provision. Over-provision in the private sector, in private markets, speeds up the cost of key resources to the public health sector. So the reality, colleagues, was that medical practitioners in particular in private practice lacked funding to be able to execute the PPE contracts that they had won, money to buy the medical ingredients, supplies, PPE equipment, etc., which forced them to either sell their contracts to big entities for execution. Some of the ingredients or raw material that were required for sanitizers, for example, suddenly became unavailable or available in limited quantities at a higher than normal prices, thus making it unprofitable for SMEs to participate in the PPE supply contracts. Even private health practitioners, chemists experienced a decline in walk-ins during the pandemic. Then on the banking sector in particular, which we really had a big interest as a department because we are also observing the National Credit Guarantee Scheme that was pronounced upon by the President and the very low uptake of the scheme. Small enterprises are still viewed as very risky to be granted credit facilities by many financial institutions, particularly the banks, of which one reason why many of them did not meaningfully participate in the PPE contracts. Their riskiness emanates from the fact that they have poor balance sheet, do not command target markets, produce poor quality products, lack requisite skills, etc. And thus, according to many financial institutions, lending money to them is too risky. Unfortunately, that attitude was still prevalent during the COVID-19 period, even when the small enterprise had secured the PPE contracts and only needing money to execute it, and had contracts available to seed as security for credit facilities. Many small enterprises were thus forced to approach loan sharks for funding, who charge them exorbitant interest rate or rely on their families and friends for financial assistance. The payment holidays that were provided by banks offered did help ease the burden on some of the SMEs in the short term, as repayment installments had to be deferred to future dates. But this has long-term negative impact because the repayment terms were prolonged, resulting in an increase in the total debt. Also, many SMEs had complained that banks suspended payment holidays too soon before they could generate enough cash flows to be able to start the repayments. Also, the reduction of interest rate by banks did provide a temporary relief to small enterprises though temporarily in the form of reduced monthly installments. Big entities with huge banking facilities benefited the most from the payment holidays as they were able to divert those cash reserves towards the execution of the PE contracts, whilst SMEs with no bank facilities nor readily available cash were unable to access the cash reserves. So, colleagues, I thought I should just raise some of these issues to reflect as well on the interventions that have been introduced, just to highlight the challenges that are still facing small businesses in this space, of which if we are serious about trying to transform the economy, we need to take the interest of the SMEs at heart. They should be at the center of whatever government regulations or government act we come up with. I thank you for now. Thanks.
Thank you very much, Lindo. Now let's let the debate begin. And I just want us to weigh on the pros and cons of dual regulation of measures by way of competition, as well as public interest regulation. To some extent, you have already answered this question in your opening remarks, but perhaps let me frame the question in a more pointed way, because it has been raised within the context of the debate around the Burger King transaction. Is it then appropriate for a competition regulator or for competition authorities to also act as public interest regulators, particularly within the context, the regulatory context, where we also have other public interest regulators, such as, for instance, the Triple BE Commission. Pamela, I think let's follow the same order or sequence.
Thanks, Mike. Unfortunately, two of my neighbors have started mowing their lawns, so there might be a lot of feedback in the background. I'm sorry about that. I mean, I don't know that this is a new question. There were long debates about whether the Competition Authority should have jurisdiction over areas where there are other regulators. And I think this has been resolved in that where there are competition issues, you know, the Commission has that jurisdiction regardless. This was the case with the relationship between the competition authorities and the sector regulators. In terms of the specific question around public interest, I think we need to understand the dynamics that are at play. So if you think about this from the perspective of inequality, there are three, I think, different ways that people tend to look at inequality. You think about inequality of opportunity, and this you can equate with barriers to entry, right? So if you do not have the opportunity to be able to contest markets and succeed in markets, this can be explained from the perspective of barriers to entry, and competition authorities play an important role in dealing and addressing with barriers to entry. And then another way of dealing with that inequality, another way of looking at inequality is about looking at wealth and income, right? So the issue around the provisions looking at ownership and the ability of Black people in South Africa to be able to own things, that deals with that aspect. And then obviously income deals with the question about employment. Now, why do those things matter for competition? And this is because in order to have dynamism in the market, in order to have sustainability, you need to have inclusion, and you need to have players that can contest markets. These should be Black, all races, but in South Africa, Black entrepreneurs matter because Black people make up the largest portion of the market. So I think looking at it from that basis, it seems quite obvious that yes, the Commission, has and should be looking at these issues, because in order to have competition, in order to maintain and sustain competition, you need there to be other players in the market.
Thank you, Pamela. Tamara?
Thanks, Bake, and thanks, Pamela. I think I have touched on this in my opening remarks, and Pamela has actually mentioned some of the points I wrote down, but it is this issue about ownership being linked to contestation and the disruptive effect of entry. So whenever I look at the public interest provisions, I don't look at them as something that is not about competition. They actually are. They're just about the fact that small businesses and small businesses matter for competition. And maybe we won't get there when we look at a substantial lessening, but we still have to consider them, in mergers. And same for transformation of ownership. And we've seen this. There are many markets that have been cartelized before in the early years of the Commission, the food and agricultural markets, and new entrants come in and disrupt those markets. Maybe not sufficiently, but that's what we are aiming for. And I think the other interesting thing around this dual regulatory mandate, if I can call it that, is that the mergers address a bit of a gap, I think. So where the BE legislation does respond to schemes that will be implemented and the likes, what merger control does is it looks at when that ownership changes, which is not necessarily something I think that needs to go for approval. But Lindy will correct me. But then that at least is captured in another regulatory forum, and questions can be asked about the effects of that, both due to the merger, but also the dynamic effects of it going forward. And I think, again, just to reiterate the point that Pam had raised, the more we talk about ownership and continued ownership, for example, when there are changes as a result of a merger by Black people, the more we also address this issue of this liquidity gap that exists, so the greater the participation, the more we address that concern. Thanks, Dr.
Thank you, Tamara. Lindiwe, are we seeing fragmented regulation of BEE, or do the two regulatory systems actually reinforce each other?
No, thank you, Bake. In fact, it is the last point, is the reinforcement of each other and complementing each other's mandate. Because when you look at, maybe just to touch on the example that you shared, the Burger King measure, wherein we know that even when we're following the developments either in the media, there was a huge contestation around why did the Competition Commission not approve it, citing aspects around transformation. Now, looking at that, there may be three things that one needs to reflect on. Firstly, remember what the whole essence around that was. We are not approving it because we want to prevent a transgression of transformation. And the legislation from a B point of view allows for that, because the B legislation says Competition Commission, when you're authorizing, apply the relevant codes of good practice. Now, one of the aspects under the relevant code of good practice is ownership. So from a B perspective, would have been very worried if the Competition Commission would look at a measure and not consider the aspect around transformation, which is a public interest issue. And also the fact that we need to make sure that as we talk about competition, it's an inclusive competition. You are bringing back those that were excluded from participating. You are bringing back those that were prohibited by the high entries to barrier within certain markets and certain economies. And to make sure that even as you're regulating competition, it must be fair in a sense that the ones that are generally affected by any unstructural challenges in the economy would ordinarily be bad people. So we need to be mindful of that. And the second thing that we need to reflect is that you can never have a super regulator from my own point of view. Each and every regulator that exists will exist from a particular piece of legislation. And those pieces of legislation, they would, even though they are maybe focusing on BBB legislation, one focusing on competition, those two, they interlinked, because competition is done by who? By entities. Entities is who? Entities who are Black owned, entities who might have minority Black shareholders. So that is why we are saying that you'll always find the two of them coexisting. And that is why we believe that the MOU that the BBB Commission has with the Competition Commission assists then in complementing the two mandates of the two regulators. To say that if you are faced with a measure that you need to consider aspects around transformation, you've got the backings of the BBB Commission where you can be touching base on and asking guidance from that point of view. And then the same thing with the BBB Commission, which then gets me to my third point, in a sense that the BBB Commission has not been given any mandate to approve any transaction. So if you remove the inclusion of aspect around transformation from the Competition Commission, then whom are you leaving it to? Because then the BBB Commission has not been given that role. It has, however, been given a role to receive transactions of 25 million and above. That includes the participation of Black people. Now, it comes already after it has been concluded. It comes already after it has received the necessary approval, if it's a measure from the Competition Commission. Now we are assessing it from compliance with the BBB legislation. And the same thing, if we would come across a transaction that when you look at it, we believe that it should have gone to the Competition Commission to also consider it under the measure provision, who then advise the parties that they also need to go to the regulator to be doing that. And I think just to reiterate again that it is important that when we look at public interest issues and competition, we understand exactly what we all seek to do. And we also have to look at it from the point of view that public interest by its nature, it stems from the Constitution. And in this instance, from the aspect of transformation, it would be your Section 9.2 that talks about introducing systems to create and deal with the system of inequality, meaning that we are trying to move to the system of equality. So every regulator in conducting its activities will have to be mindful of that. Thank you very much.
Thank you, Lindiwe. Lindo.
Thanks, Program Director. Okay. Yes, I think the issues that mostly have been raised by Lindy towards the end are the issues that I'm fully aligned with, and some of it I have raised them in my opening remarks. I think I don't see any conflict really between the work that is done by the Competition Commission as well as the issues around the public interest. Sometimes I think the debates that come up are not necessarily genuine debates. I'm sorry, I'm saying maybe something that is more controversial now. It's more of a distraction, because I think we've seen, I think some of the findings from the Competition Commission, they've upset quite a number of established institutions, and that becomes then a debate trying to sidetrack us in terms of the issues that we need to deal with or confront and deal with as a country. We do have serious challenges in the country around the economic transformation. I don't think sitting today, over 25 years after the first democratic elections, we still have these skewed ownership patterns that are really not assisting us as a country to move forward. The high unemployment rate, and in each and every developed country, small businesses are the majority in terms of contribution to job creation. So for my side, Chair, I'm very much compatible with the role that is being played by the Competition Commission, both on the side of the competition as well as on the side of a public interest, because it's quite critical for us to look at what the society needs and what are the challenges that we need to address as a country first, and deal with those issues head on. Thank you very much.
Yeah, thank you, Lindo. Let's then assess the cost implications of these public interest obligations on things such as efficiencies, competitiveness, investment, as well as consumer welfare. Of course, juxtaposing that against the benefits of public interest regulation, particularly within the context of major transactions, and whether these public interest benefits outweigh the costs to the firm. For example, an argument has been made that moratoria on retrenchments restricts firms from efficiently allocating labor costs, and that there's also a risk that these public interest obligations, because they impose a cost, end up being passed on to consumers. An argument, excuse me, has also been made that these public interest issues may also disincentivize or deter investment, ultimately impacting on the cost of doing business in South Africa. I think let's follow the same sequence. Pamela. Sorry, Pamela, you're on mute.
Yeah, I'm back. Okay, so we can't avoid that there are cost implications that come with the public interest provisions, but how they net out in any transaction depends on a number of factors. So there's no straight answer, like there's no one answer that is would be applicable for every merger in terms of, you know, are they worth it, or are they do they outweigh the costs for a particular firm? That would have to be within the context of particular information or circumstances surrounding that particular firm. I'm going to go through the points that you raised, but maybe starting with deterring investments. So yes, this has been raised around the deterrence of investment, but I think most, if not all, countries have some sort of rules of the game in terms of how you play in that particular country. And these public interest provisions are part of the rules of the game of South Africa. And you then make an assessment as a firm if it is worth it or not. I think if you look at the kind of studies that have been done on profits in some of the South African markets, the answers tend to say that those profits are really high, which would suggest you do your calculus and it might work out that actually this is a small cost of doing business in South Africa when you think about how much you could gain in terms of the profitability levels that you can reach in this market. And also, I mean, I think the kind of dynamics that you see in firms is that sometimes when there are rules like this, it pushes firms to innovate and think better about how they could be, achieving more profitable levels. And so then I don't think that there's a big deterrence effect from that perspective. In terms of I think the cost implications, I think you mentioned in particular around employment and retrenchments and what this means for competitiveness. I mean, I think this is one of the things that comes into the whole idea about how you balance the various public interest perspectives, because that is more of the kind of static effects where, because you're trying to keep employment at a particular level in any given point in time. But investments and others are more dynamic in that you can get more for the economy out of that. I think those ones, particularly around requirements on employment, are there because of the state of the South African economy. But I would expect once we start performing better, those are the kind of things or provisions that would be done away with. But because of just the nature and the dynamics in the South African economy, it is something that is still required. I'll leave it there for now.
Thank you, Pamela. Tamara?
Thanks, Bake. It's always hard to go after Pam. I have to start crossing off my points. I think the point around employment, I wanted to pick up on that. Bake, you had mentioned it as an example, and I think it is a useful one to think around this issue of costs versus benefits. I think we have to ask ourselves as a society, what costs are we willing to bear? So this issue around a trade-off, merger may generate efficiencies. If those efficiencies come from firing workers, is that a cost that as a South African society, we are willing to bear? And I would say, given the current context, no. But that doesn't mean that we are negating all efficiencies from the merger. We are saying, those should come from elsewhere. They can come from innovation. They can come from seeking new markets and the likes. But if that's simply your baseline, that this is where these efficiencies should come from, then that is not something, as Pam would say, would be allowed in the rules of the game. I think the other issue around the benefits from from pushing firms to consider, the full ambit of the benefits that could come from public interest commitments is one that is particularly valuable. And we can go back to the Walmart case, which I think was precedent-setting around the supply development funds and the disruption that can generate in markets and the facilitation of the entry of smaller and new entrants into those markets because of merger conditions. I think the benefits of that were probably underestimated by Walmart, which, initially there was some opposition to this idea that the fund was necessary and, what it could do. But then over time, the Commission has done an impact assessment on this and created UJ through Arena, Professor Dasne, has also done some work around this. And what they've found afterwards is that this supply development fund was actually, in a way, in the interest of Walmart, because what it could do is use those funds to disrupt concentrated supply markets. So you develop these new entrants in markets where you yourself have limited bargaining power, you support those new entrants. And in fact, in one of our later mergers, which was in the pool product segment, one of those suppliers who was supported through the SDF initially, was a beneficiary of an additional merger fund and has been able to expand into new products. So I think when we think about these benefits, the benefits come later as well. So the costs are probably apparent at the time when we are engaging in the conversations. and the benefits then get discounted because obviously they come over time. But there's no doubt in my mind that there have been significant benefits.
Thank you, Tamara. Pamela, you want to have a second bite at the chairing?
Yes, sorry, there's one point that was in my notes that I missed, and I think some of what Tamara was saying about a Walmart brought it to mind. I think the question that I have around the kind of like the interventions from a public interest perspective, and particularly in mergers, is the extent to which this then affects broader competition in that particular product market. And if I can make an example of Walmart. So yes, there were all those concerns, and yes, the outcomes have been really good. But what does that do in the ability of Walmart to compete with, the bigger supermarkets in the South African market, which are, your ShopRite, Pick n Pay, Woolworths, etc. So I think always where it is possible to have an overall a solution or a broader based solution, that is something that we shouldn't shy away from as a country. But of course, I'm not saying that this means that we shouldn't do it within mergers, but particularly in the example around supermarkets, I think other countries have gone with a supermarket's code of conduct to deal with some of the issues that the Walmart merger conditions did. But in South Africa, because we were only doing it through the lens of a merger, we could only do it for the Walmart Massmart and couldn't apply it more generally to the others. So that is something that I think we need to continue thinking about and resolving. Thanks, Mike.
Thank you, Pamela. Lindiwe?
No, thank you very much. I think both Pamela and Tamara are making very valuable points. And I think for me, how I would respond to the pros and cons, maybe two things to note. The first thing would be, maybe we must first check the motive of saying that the costs are higher compared to the benefits. Because in any regulatory environment, when you begin to regulate, the cost will always be seen or be raised as something that deter the activities that needs to be taking place. But at the same time, the question that we need to ask ourselves is that if we don't talk about or regulate aspects around public interest, will they really be considered? Would a measure be presented without necessarily reflecting on retrenchment? Would a measure be presented voluntarily indicating the bringing in of small businesses or the previously disadvantaged? Now, when you look at history of regulators, they would indicate that these things don't happen automatically. And they are brought in through regulations because we've seen that the absence of public interest issues can really cause the South African economy to remain unequal. And then if we don't do it as regulators, who would actually take that lead and actually do it? So when you look at retrenchment, for example, or preservation of jobs, we are one of the countries with the highest rate of unemployment. And we've seen the previous 5 years, it seems to be increasing and increasing. Now, what we would be doing a dissatisfaction if we are looking at all these other economic activities, but we don't look at considering the preservation of jobs. And at the same time, when you look at the investment of government in different sectors in making sure that it resuscitates economic activities and making sure that it supports certain businesses, either from a manufacturing point of view or from those sectors that we believe that they can be the drivers and the engineers of growing the South African economy, we need then to bring in a balance to say where we are able to be safeguarding jobs and be able to reduce the rate of inequality and also reduce the rate of unemployment. We should be able to be doing that. So I agree with Tamara when she mentions that the benefits are in the long run, but we would need to be incurring those costs so that we can be able in the long run to enjoy those benefits. When you look at barriers to entry, we can support small businesses through funding, but when they don't have access to markets, when markets are concentrated, when markets are locked, and no one can come in, we are doing a dissatisfaction on small businesses. And research shows us that when you support them, they're able to absorb the number of jobs that we are putting together as an economy. So, and also the last part, when you talk about it is not good for investment. We hear that a lot. Even in the space of transformation, you always hear that it deters investment. But have we really done a thorough research and really checked whether this is actually factual or it's something that can derail what is it that we are seeking to achieve? Public interest issues is not something that is malicious. And remember, this comes about after you do your consultation, after you look at various aspects, but at the end of the day, you need to be coming up with a position that this is what we want to be looking at. So investment will continue, but I think if we don't address them, we may eventually deter investment, because who would want to come and invest in a country that is highly unequal? Because the moment we have an unequal country, you start to be thinking of what we saw in July as a country, and that on its own will be deterring investment. Let me end at that. Thank you very much.
Thank you very much, Lindiwe. Lindo.
Thanks, Bake. I think there are costs, obviously, that are involved, but as a country, I think we need to really gauge and see, which costs can we bear for in the short term, and those that we really will affect us in the long run. So I believe from my side that the cost that we are expected to bear by ensuring that we protect those jobs that are already there, it's things that we can carry, as big corporates, because the social instability, I think, that we witnessed in the country, and you can see that these things, are not really about politics, but it's more about people who are sitting doing nothing. And with the high unemployment, which keeps on increasing, we are not going to be, reaching any stability as a country. So my view is that the price that we have to pay by protecting jobs is lower than the price that we will pay by having a country that is socially unstable. We still going to continue with these skewed economic ownership patterns, which really are not good for us in the long run. I think we have seen some economists and some analysts saying this country by 2020 could be a failed state, which is really a challenge for us as a country. And if we really decide that let's protect the interest of a few at the expense of the many, of the majority in the country, we'll have serious challenges. I think as government also, we do have a serious role to play, because we have to assist our country and drive issues around structural adjustments, ease of doing business, cutting down red tape. So there is something that as government will need to come in and play that meaningful role. It's encouraging that even the new Minister of Finance is really strong on these issues, and he wants to make sure that government play its role of creating a conducive environment for businesses. I believe innovation and agility is key for businesses going forward. I really don't think that we need to go back and sit and look at those things that used to be easy to deal with, issues around just dismissing employees. There are opportunities for us to train and make sure that the employees that have been there, we can retrain them, they can expand, and ensure that our businesses, are able to go forward. On the issue of investment deterrent, I think this one is a very convenient issue that is always raised by people if they are not happy with a particular issue. You can see that most of the people who are investing in the war-torn countries, they come from other countries. They come especially from Europe. They go to Sudan and go invest there, for example, because they see the business opportunity. So it's not more about the light issues that we always raise, that, if you come up with this regulation in the interest of the public, then you are deterring investment. I think once a business or a big corporate decides to go and invest in a particular country, they go irrespective of what regulations, because they look at the opportunities that are being offered in the long term, because they don't go for short-term investment. If you invest in an infrastructure in a particular country, you know that you are looking at the long-term gains. So these are the short-term costs, that they can bear in the meantime, but knowing that there are long-term benefits. Thank you very much.
Yeah, thank you, Lindo. Before we go into the public Q&A, just one last question which has been raised from an investor perspective, and this relates to the certainty to investors about the outcomes of the process, because that clearly has implications on investment decisions. So are the outcomes of public interest regulations clear and predictable? Pamela?
I mean, I think Tamara raised this before, that the commission over time had started adopting a particular way of analyzing public interest provisions, and there were public interest guidelines, so you could very much clearly predict what you needed to do when you're submitting your merger, and also what kind of what the outcomes from the competition authorities would be on that basis. Of course, now, because the Act has been amended, and particularly the public interest provisions of merger analysis have been amended, there are questions about how it is that things are going to balance. And this is what I mentioned earlier, in that it's going to take some case precedent in order for us to see and to get some clarity on some of the questions that aren't obvious in terms of what the answer is. And one of that I mentioned, of course, was around the balancing effect. And in terms of the outcomes, in do we achieve what the public interest provisions seek to do, I think the studies that Tamara referenced to show that there has been positive outcomes from a number of these transactions where there were public interest conditions placed and the mergers went through, and those firms, still continued with their investment, and they've still been able to participate in their markets. Thank you.
Thank you, Pamela. Tamara, should Burger King have seen it coming? Ability point of view.
Well, I think it's there in black and white, right? in the legislation, as the minister mentioned yesterday. But I think on the whole, there is a point I wanted to make, around public interest. On the whole, of course, Burger King was the first transaction to be prohibited solely on public interest grounds. But I think the counterpoint that must be made is that means that over the past 20 years, what we've had mostly is positive engagement and an agreement on the conditions. So I think that is no small thing, right? That parties do, generally when we raise these issues, there is, engagement, and we do come to a place that's mutually acceptable to the parties concerned. Could there be greater clarity around the amended provisions? Yes, potentially, but yes, of course. But as Pam has said, and as I tried to allude to in my opening remarks, we do benefit from this engagement that has occurred over the past few months. There have been differences in interpretation. You can ask parties questions, and the responses they come back to is somewhat surprising. And frequently we've had to reach out to our colleagues at the BEE Commission, and we'll go and say, Lindy, is this how ESOPs work? Is this truly how, BEE ownership is still recognized after X number of years and the likes? So there is some learning that's happening, and I think that is only a benefit to eventual guidelines that can be developed. In terms of implications for foreign direct investment, I think, I can echo the sentiments of the acting DG and Lindiwe around what's really bad for FDI, I think, is the kind of economy that I had set out before, where you have this massive unemployment rate, where you have this the lack of transformation. So whether that FDI is seeking new markets, it's not going to be found in an economy that's not growing. Whether it's looking for strategic assets, it's probably not going to be found in an economy where there's limited innovation. So in the end, I think it's not really a question around the public interest. That's a really smaller part of this bigger puzzle around the kind of economy that will attract FDI and growth. Thank you.
Thank you, Tamara. Lindiwe?
No, thank you, everyone. Mine is really short. When you mentioned, Bake, that should they have seen it? is to say that there'll always be a scenario wherein the provisions will be implemented. There will always be a particular measure, a particular transaction where certain provisions will have to be applied. And as it has been indicated, the legislation or the regulations or the provisions are there. But what is critical when you have that, or what learnings that we can take from this, is maybe they need to increase our advocacy around those particular aspects. And that is what we can do as a regulator, so that we begin to sensitize everyone, so that transactional advisors, the lawyers, all of them, when they craft this, they bear in mind that there are these provisions around public interest, and this is what it means. So when we are putting together or while looking at these measures, we also need to be mindful of those particular aspects. I think we can do a lot to do that. And that also will allow our regulators to bring the clarity that is needed. Because when you regulate and there is no clarity, and you are not providing that as a regulator, you are opening up room for gray areas. And those gray areas can be subjected to a number of interpretations, which can derail what is it that you want to do, which can derail the introduction of public interest aspects in measures, because everyone will be interpreting it differently and everyone will be seeking to get a declaratory order against the aspect around interpretation. And in the long run, it does not assist anyone. And then also probably what we also need to be bringing in is that once we've set this public interest conditions, we need to then monitor them. Then the research that Tamara referred to, and I think also Pamela touched on, becomes very important, because we need to demonstrate that at the point of approval, we have set this, and this is how it has been performing, and to show and reflect positivity of that to the broader economy, and then also preserving aspects around competition, or also aspects that we've also looked at in terms of public interest. Thank you very much.
Thank you, Lindiwe. Lindo.
Thanks, Bake. I'll be very brief. I think colleagues have covered most of the issues, but I believe, as government, we need to really be clear in terms of communication. I remember in the past, when we were part of TTI, we used to have these engagements with various corporates, and it is always ideal when you have engagements with these multinationals, you also have South African corporates sitting in those sessions, because sometimes they have a better understanding than the international or multinationals. So it's always good to always communicate as government, clearly outline the advantages of these interventions. We are not just as government jumping in, it's something that we did not even research. We just do this thing as the first option. We do consider quite a lot of options, but when we have to intervene and regulate, it's because things are not happening in a particular fashion. So I believe that it is also in the interest of those investors to learn, to take responsibility and learn about the certain obligations that you have to meet if you want to invest in a particular country. And some of these big corporates, especially the multinational ones, they do have similar regulations in their own country, but they expect us to do things different when it comes to South Africa, because we need the investment. So I do believe really the regulations are very clear and they should be predictable, but maybe it's too early to make those assumptions. Let's see, in 5 years or 6 years time, how these public interest regulations implementations going. Thank you very much.
Yeah, thank you, Lindo. Let's now go to questions from the floor. There is a question from Nontlantla Caesar. She's asking whether the lack of transformation and participation in our economy is more of a function of underperforming economic policies, or is it the legacy of concentrated markets? So is this a competition problem or a broader economic policy problem that requires solving to encourage investment and participation. Or actually, it looks like it's actually Wiri Gumbi who is using somebody's laptop or device. The second question is from Vipal Daj. He or she says, Tamara, thank you for your valuable remarks about amendments to public interest guidelines. Which particular areas will these guidelines clarify? Also, by when can we expect them? Thank you. The last question is from Sia on the issue of the dual regulatory mandate. And the question is whether there's any legislative provision that prevents regulators from sharing information without compromising their independence. Let's start with the first question about whether the lack of transformation is a function of underperforming economic policies, or is it the legacy of concentrated markets, and whether we are actually dealing with broader socio-economic problems that are manifesting themselves as competition policy problems. Pamela?
So I think the two are connected, and also I'm not entirely sure what is meant by economic policy, because competition policy would make part of that. But maybe a more useful answer is to say the two are connected. So we need to take into account that there is power in various economic entities, and that power it does not only manifest in terms of market power, but can also be power to influence economic policy in a country. There's a lot that's being written about this. I think Luigi Zingales is a person that I would recommend if someone wants to look more into that. So yes, there was the legacy of concentration, and there were various economic policies, including competition. In fact, competition was the primary policy that was used maybe in the first in the first period, I don't know, maybe the first 20 years. I think we were relying very heavily on competition policy to address issues of concentration in the South African market. I've lost my train of thought, sorry. Okay, so there's the aspect of that. But as I said previously, economic policies broader outside of competition also play an important role in terms of fostering competition in the market, and which includes ensuring that there are lower barriers to entry and people can meaningfully participate in the economy. So these things really come together, and I don't think we can say it's one or the other. So in terms of dealing with the power dynamics in value chains in the South African market, and also power dynamics that arise from the economic structure of the South African economy, yes, the tools to deal with that largely lie outside of competition policy, but competition policy also plays an important role in dealing with things like how upstream firms price to downstream firms. Downstream firms tend to be more employment intensive, which would mean that will more employment intensive, one. And then the second factor is, of course, that because there are typically lower capital requirements to enter those markets, it is easier for people that don't have access to vast amounts of money to be able to enter that. And this is what we would actually be looking at when we're talking about a bulk of Black South Africans. So these things are really interconnected, and we can't say it's one or the other. It is very important that they work together in order to address these issues.
Thank you, Pamela. Tamara?
I would agree with that input, that it's very hard to untangle these. I mean, I think the fact that the markets are as concentrated as they are, and all of us have spoken to this point after several years, of post 94, points to the fact that there are broader economic policy levers that still need to be used more effectively. And as Pam correctly says, this includes competition law, but it actually asks us more broadly to consider competitiveness more broadly, and other elements of competition policy, including, as I had mentioned before, around industrial policy, public procurement, and the likes. I don't think that we are saying that competition policy solely can solve this problem, but it is an important part of the solution. Around the second question on the public interest guidelines, I think there are 3 elements of the public interest the test that have been amended. So the guidelines will work from the previous version and just clarify the new elements. So for example, the issue around participation by workers in firms in the market is a new addition. So that has to be clarified a bit. And yeah, I see a lot of work in consultation with the BE Commission, for example, to understand how they see this operationalized in current schemes. And then there's also a revision to the elements around small businesses and firms owned by HDPs. It's not only entering into markets, but how they can effectively participate in markets and expand within markets to address that issue that I previously raised around progressing from small to medium to large quickly. So those are the issues that we're working on. I'm not going to commit myself to a timeline in a public forum, but suffice to say that it is, receiving attention. And then around Sia's question on sharing information, the only concern, of course, is around confidentiality, but the Commission does have MOUs with sector regulators and other authorities, and have used those to great effect to discuss matters of substance. So I don't think that even the constraints around sharing confidential information between regulators in any way undermines that process. There are also ways, to seek waivers, to engage in, even sharing of confidential information where that's necessary. But it is definitely something that can be worked around because it is in the interest of better decision making sometimes to have these consultations early on in the process. Thank you.
Yeah, thank you. Thank you very much, Tamara. I'm told that, excuse me, we are left with 3 minutes. If you can be very brief, Lindiwe and Lindo.
No, thank you very much. I'll be very brief, I promise. So on the questions that have been raised around, maybe the first one, lack of transformation and participation. I agree with both Tamara and Pamela. You can't pick and choose. It's an all-inclusive, both your policies as well as concentrated markets, because in there you are trying to deal with a number of issues, which then the policies will seek to cater for. But one thing that we need to bear in mind is that policy evolves. The state of economy that we have today, it was not the same as the previous years. So as the economy evolves, that is why we're also fine-tuning policies, because we always need to be making sure that we are at par. So sometimes we may be quick to say the policies are underperforming, but not necessarily so, because the structural behaviors in the economy have evolved. So we need to do some adjustment so that we're able to deal with how things are at that point in time. And also the thing with the importance then of economic policy is that if we don't necessarily implement it, we tend to see a risk of certain habits and cultures emerging, which can in a way make themselves or characterize themselves as policy, but meanwhile that is not so. Hence why it's important to always be fine-tuning policy so that we address and cater for these behaviors. And then also on the issue around dual regulatory and sharing of information, I think there is value, I agree with Tamara, in terms of sharing of information, because you learn from each other as regulators and you are better able to make those informed decisions, because as you cannot be an all-rounder in terms of expertise, but you could be tapping in those that are more familiar with that particular area so that you may be able then to enforce what the provisions of your own primary legislations are. And general legislations do not prohibit such, but you do it to the extent possible so that you don't in any way disadvantage or do disinjustice to any of the parties' information that is already there. You can look at aspects, just highlighting a principle, sharing of a principle to say, if this is a scenario, what does the law provide for? Then you are able to then also take that and apply it to whatever case that is being represented. Thank you very much.
Thank you, Lindiwe. Lindo, if just 1 minute, please, we're out of time.
Okay, no, thanks, Bake. I think I agree with the colleagues who spoke before me. It's a combination. I don't think really you can choose one over the other, because one of the issues that we are addressing from our side as a department is the issue around access to markets. It's a very, very critical issue. I know that most of the SMEs were raising the issue of access to finance, access to skills, access to infrastructure. But if you don't have a market, for example, really you cannot continue supporting a small business to develop. Where are they going to take their products to? So it's a balance of these things. We just need to make sure that from our side as government in particular, I think we've acknowledged that in the past we've been unable to execute the policies that we've come up with. But yeah, it's a balance between the two. Thank you.
Yeah, thank you. Thank you very much for a very lively debate. We have come to the end of our debate. I do, Mpumi, just want to make one final point. In Mediclinic, the Constitutional Court did indicate why it supports the tribunal's reasoning, especially on the critical question of market definition. So it is not entirely correct to say that the Constitutional Court did not explain the basis of its decision for adopting the tribunal's reasoning in the matter. Thank you.
And on that note, I can see the regulators at the bottom. We needed our chance. Hey, we needed to speak back to Judge Dennis Davis. Thank you so much to that panel. You know, I'm left with a couple thoughts, some of them being, I wonder the extent to which we're having, because I do think that part of this panel was speaking back to a voice that maybe isn't in the room now, but that, for example, Tamara intimated about when she was speaking about the kinds of answers she receives from market participants when trying to engage on issues of this type. And I really wonder whether there is less of a jurisdictional or a legal disagreement and more of a disagreement on the facts. Because a part of me wonders, is the lack of an appreciation of the urgency of the intervention about a misapprehension of how the other side lives? Could that be part of the problem? Because I do think that the numbers are stark. When Tamara comes in with the facts of the state of exclusion, it's really hard for me to understand arguments that don't think that it is a great source of urgency that we are intervening in these ways that we were speaking about today. And particularly, you know, it stops us from having more fruitful discussions about, for example, the economics, some of the heterodox economics writings that have debunked the causal relationship between FDI and growth. There are writings that say that perhaps the relationship is actually a reverse one, and not that FDI creates growth, but rather we need to first empower these SMEs and get our HDPs back in the markets to start seeing growth before we can start to see more FDI. Perhaps that is the causal relationship. And then, of course, something else that was really great that came out of today's session that I felt was touched on is the extent to which these issues needn't be divisive. Not all parties are going all the way to the CAC to fight public interest issues. Rather, what we've seen in the past is a consensus building process. And what I'll note about, you know, Burger King is that it came to the tribunal, and this is public knowledge, it came to the tribunal on a consensus basis. There was consensus between the commission, the minister, and the merging parties when they approached for a reconsideration application. So a lot about the extent to which there may be conflict in public interest has been debunked in our conversation here, and I hope further. Now, I have the distinct pleasure of introducing my chairperson. This is Ms. Mondo Mazwai, who, as you all are aware, is the chairperson of the Competition Tribunal, the other organization that is hosting this conference for you all over the past couple of days. I think the Commission is well known for its advocacy efforts, but I also want to pitch in and say the Tribunal too was part of organizing this conference, and it is fitting that we have the head of the Kota Quo, the Competition Tribunal, to address us and close us out. And the joy that it is for me to be able to introduce not only such a distinguished practitioner who has practiced for over 20 years in both public and private sector, who's worked at the Commission, who's heading the Tribunal. Not only that, but she plays an important representative role as well in being the very first person of color and the very first woman to serve as the chairperson at the Competition Tribunal. So once again, it is an absolute pleasure for me to be able to hand over to Ms. Mondo Mazwai, who will give us the closing comments from the organizing tribunal alongside the Commission in closing us out on what has been a really, really great conference. Over to you, Mondo. I think you're on mute, Mondo.
Thank you, Mpumi, and good afternoon, ladies and gentlemen. It is 16:03 on a Friday afternoon, and given the intellectual stimulation at this conference in the last 3 days, I promise not to detain you any longer than necessary. To quickly remind us of the takeaway lessons from the conference, Dr. Somadoda Fikeni set the tone as the Public Service Commissioner with an inspiring talk on what a capable state looks like and what the country should be doing to seize the moment, not to waste the good crisis that has been created by the pandemic. This theme was continued in a later session led by Professor Busani Ngaweni, who leads the International School of Government. There we gained incredible insights from the enchanting Portia Dabi, who shared perspectives on running a state-owned entity and the building blocks to do this successfully, including generating an interest by professionals to work for the state. The next day, Professor Bill Kovacic touched a little bit on this from a US perspective when he talked about, in his lecture, about the team that the President of the US, President Biden, has appointed to the Federal Trade Commission, a team rather that the President has appointed to the Federal Trade Commission led by Lina Khan. We then got to the business of how we rolled our sleeves during the pandemic and had perspectives from South Africa in both the Tribunal and the Commission, as well as Kenya's experiences. This was followed the next day by a deep dive into sectors of the economy that can accelerate recovery and in which competition can play a significant role. We had interesting perspectives on digital markets, agriculture, and food supply chains, just as a few examples of where the acceleration could happen. The highlight on the second day was the minister's address. He provided very rich content about the direction of travel for competition law and policy, as detailed in the Competition Policy Strategy for Jobs and Industrial Development, issued in May this year. He emphasized the importance of a competition policy that promotes industrialization and which addresses skewed ownership structures and concentrated markets. We commemorated the sad loss of the late Rob Lee and Judge Mnguni, whose contribution to competition law and policy will be missed. Later on, we honored Professor Elena Fox for her pioneering work in challenging how the world not just developing economies, should be thinking about competition law and trade. Just 20 years ago, Elena seemed to be a lone and dissenting voice in promoting competition policies that address socio-economic ills in an economy. Bill Kovacic, in his lecture yesterday, spoke about how today the US is converging with South Africa. The takeaway lesson in thinking recovery and reconstruction is the instructive statement from Elena's lecture, which says, if the law keeps helping the elites and hating the worse off, then something is wrong. Judge Dennis Davis shared some reflections on competition law over the years and reminded us, particularly at this inflection point, of the importance of cross-border competition issues as highlighted, for example, in the bank's Forex case. He promised to write an article on the seminal judgment of the Constitutional Court in Mediclinic. And today, Advocate Mukaidobi opened the session with a thorough exposition of this case. I always enjoy the robust debates between Advocate Mukaidobi and Judge Dennis Davis because they deepen and enrich competition jurisprudence. I'm glad in this instance that we can enjoy the debate for what it is, since we don't have to write a decision. Nevertheless, it was interesting to hear the dichotomy of views. Mukaidobi sees light at the end of the tunnel, and Judge Davis sees a train coming. We heard from Phakamisa Nzamela through his book, launched this morning, of the historical creation of exclusion and the building of barriers to entry that remain a characteristic of the South African economy, and which the Competition Act seeks to address. We were later led by Judge Davis in the plenary on the pharmaceutical industry, which has been a key concern because of the access to vaccines to combat COVID-19. The panel highlighted the regulatory gaps that exist and that may enable monopoly pricing for pharmaceutical products. And they all agreed that there is much to be done, not just in the competition space, but in other areas of regulation too. We concluded this afternoon with the interesting debates by the panel, which looked into the scope of the Competition Act as a tool for economic transformation, and in light of the BEE legislation that already exists, and what the impact of this has been on merger control and merger assessment. I have no doubt that you will agree with me that there is much food for thought gained from this conference as we rethink competition policy in the context of recovery and reconstruction. And if I may echo the words of Dr. Somadoda Fikeni, do not let a good crisis go to waste, he says as he was requoting Winston Churchill. And so with that said, I wish to thank the many contributors to the conference, and some of them may not be here, starting firstly with Bill Kovacic and Elena Fox for taking the time to deliver insightful lectures despite the time zone differences between the US and South Africa. I also want to thank international speakers that spoke on the various panels. Francis Kariuki, the Director General of the Kenyan Competition Authority, Alejandra Prieto, the former chair of COFES, Dr. Clive Ondari, Director of Health at the World Health Organization, Greg Hammond, BRG Consulting. I'd also like to thank the 6 facilitators of the plenaries that we have had over the past 3 days, Yasmin Karim, Professor Bisani Ngaweni, Professor Fiona Tregena, Judge Dennis Davis, and Bukosibake Majenge. I thank also the panelists. I won't mention each by name, but thank you. And thanks to the discussants and contributors to the academic sessions that we have had, and there were 4 over the last 3 days. And lastly, let me thank the staff at the Tribunal that has been providing support in the background, and similarly to the staff of the Commission that has carried most of the planning and the logistics of this conference. Importantly, I must thank the program directors, Mpumi Chabalala and Simpiwe Gumede, who have ably and very energetically navigated us to this point. The final thank you is to my co-host, the Commissioner, Mr. Tembinkosi Bonakele, for his excellent stewardship of the conference. He has done enormous work, not only to put the conference together, but he has been spearheading and facilitating numerous projects as we learned from the conference. These include the launch of the multidisciplinary research program that will contribute to the development of competition law and policy, and the numerous memoranda of understanding signed at this conference, and notably the one between the Competition Commission and the Information Regulator, as well as the launch of the ACF Aviation Reports, which is expected to benefit consumers traveling on the continent on price and choice. So please join me in thanking the Commissioner and everyone who made this conference the success that it has been. Have a great weekend and thank you.